Hi there, Jason Moser here, analyst with Motley Fool One, and thanks again for joining us for another edition of Ask a Fool. And today we're trying something a little bit different. We actually have Jason Newman on the line here with us in New York, and Jason's going to ask us his question live here on the phone. So Jason, go ahead and fire away with your question.
Sure, thanks Jay, I appreciate you taking the time. My question for you today is, if we're going to assume that a regular investment approach of, let's say, a certain amount of money on a regular basis is the key to successful investing over the course of a lifetime, then how do you suggest we treat larger cash infusions that come over the course of a year? Should we be increasing those regular contributions, putting all that money in at one time, or saving it back as powder for opportunistic buys in the future? Thanks so much.
Yeah, it's a great question. I think something we get a lot is that people who invest regularly and occasionally will have a cash infusion for whatever reason. They get, another certain amount of cash that they need to figure out exactly what to do with. For me personally, when I look at something like this, I think, number one, the one thing I've learned as an investor, year in and year out, I always reiterate, never rush. You shouldn't feel like you're in a rush to get all of your money into the market, because it seems like you're never going to really buy at the bottom and you're never going to sell at the top. I mean, there's always, I think, a better opportunity around the corner as long as you're paying attention to the companies that you're holding. So, when I look at something like this, for example, I see two things. Number one, I think it's a great opportunity to add to positions that you already have in your portfolio, some of your favorite companies. And then number two, I think it's a great way actually to grow that watch list that you may have. And if you don't have a watch list, I strongly encourage building a watch list. But getting these infusions of cash can help you do that. So personally, for me, I always like to keep a little cash in the portfolio for opportunities whenever they may come up. And maybe that's 5 or 10% of my overall portfolio. That's really what you'll have to determine you feel most comfortable with. But I would certainly never feel rushed ever to buy into the market. I think deliberate is always a safer play there. And you look at some of the services here that we have at the Motley Fool, and I think one of the best features of a lot of our services is the Best Buys Now feature, because every month we're offering you the most timely advice, the best companies at that particular time. And so I think that's a helpful way to build a watch list and to certainly get some new ideas, particularly if you have some extra money rolling in. So, I see this as an opportunity to grow your watch list and an opportunity to add to companies that you already own. And something else that we profess here that I think is really effective, actually, is buying companies in thirds. And it could actually be buying in fourths or fifths or sixths. But the basic idea is that you're not just opening a position in a company and buying it all just at once. Maybe you have a company that you're interested in, you want to get some money into it and get some skin in the game, you buy a small position, you follow it, and then maybe at some point, during the year, there's an earnings miss or something that offers another opportunity to add shares at a lower price. I mean, I enjoy being able to do that, and I think that's where having that extra amount of cash in the portfolio can be very helpful. We had Chuck Akre here recently talking with us at the Fool, and he was talking about this Wall Street syndrome. It's beat by a penny, missed by a penny syndrome. And you see quarter in and quarter out, and I'm sure you see it as we do, is these companies that are performing very well and have tremendous business models in these great long-term futures, they may miss their earnings estimates by a penny or two, and the Wall Street sells the stock off because of some short-term concerns. And so for us, I think that represents many times some great opportunity there to add shares of your favorite companies. So that's where it's always helpful to have that extra cash in your portfolio to do that. But the bottom line is, never ever feel like you have to get all of your money bought into the market at a certain time. Don't try to time the market based on any events that may or may not happen, because it's just too difficult to do. Some you hit, some you miss, and you end up really not owning the companies that you want to own for long periods of time.
Thanks so much, Jay. Really appreciate your time and valuable insight as always. Look forward to hearing again from you soon.